Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Hello everyone and welcome to InvesTips from the CIO's desk. I'm Steve Brice, the bank's Global Chief Investment Officer. Today's topic is one of the most common questions investors ask themselves. Should I try to predict when markets will rise and fall, or is it better for me to stay invested over time? Let's dive in. Have you ever missed a flight? Well, most of us rarely do because we can estimate how long it takes us to get to the airport. Traffic, distance and travel time are reasonably predictable, and as long as you add a reasonable buffer, you'll usually be okay. But financial markets are very different. Markets are influenced by thousands of factors every single day, including economic data, corporate earnings, government policies, technological developments, and investor sentiment. And many of these factors change constantly and without warning. That makes predicting short-term market movements incredibly difficult, even for experienced professionals. Over the years, experts have developed different theories to explain how markets work. One view is that markets quickly absorb new information, making it very hard to consistently predict what happens next. Another view recognizes that markets are driven by people, and people are not always rational. Their fear, excitement, and overconfidence can all influence investment decisions and therefore market prices. And a third perspective combines these ideas and suggests that markets are constantly adapting as investors learn and react to changing conditions. Now, while these theories differ, they all point to one important conclusion. Accurately timing the market is extremely difficult, and the evidence supports this. One study, looking at the US stock market for many decades, found that investors who missed just a handful of the market's best days saw dramatically lower returns. The challenge, of course, is that nobody knows when those best days will occur. And indeed, some of the strongest market rebounds happen shortly after significant market declines. This is why investors who sell during periods of fear often risk missing the recovery that follows. Another long-term study compares two approaches. The first investor steadily invests his money in the market over time. The second investor has some cash on the sidelines, waiting for the market to appear cheap. Now, you might expect the patient investor who's waiting for markets to be cheap to achieve better results. But over more than 2 decades, the steady investor actually came out ahead. And the reason was simple. While waiting for the perfect opportunity, the patient investor missed periods when the market continued to rise. Of course, the lesson here is not that markets never fall. Of course they do. The lesson is that trying to predict every peak and trough is usually less effective than maintaining a long-term investment plan and following it with discipline. In fact, market downturns can often create opportunities. So rather than trying to identify the exact bottom, investors may benefit from accelerating investments during periods of weakness. This can help lower the average purchase price and position the portfolio for a future recovery. Most importantly, investment decisions should be guided by careful planning and strong fundamentals, not by emotions such as fear or excitement. So if there's one message I'd like you to take away today, it's this. Market timing may make you lucky once, but time in the market is far more likely to help you build wealth over the long term. Thank you for listening to InvesTips from the CIO's desk. I look forward to sharing more insights with you next time. Until then, please take care.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.